Hello and welcome back to another podcast, but not any other podcast. It's a special 100th episode edition today. And who else would we have on the podcast other than Doomberg? Doomberg, welcome back to the show. It's a pleasure to have you on. I've been reading your piece around hits and misses, a bit of a reflection on the content you guys have put out over 2025. And from what I read, you've surpassed all growth and goals for the year. So congrats on all the success. I want to know now, what's got you most excited looking forward to 2026?
Yeah. So first of all, Ben, congratulations on reaching 100 episodes. It's a great honor to be your centennial guest, I suppose we would call it. And having been in and around the content creation business for some years now, I know it's hard to stick to it and to just keep producing. Congratulations to you. You're in the rarefied air of those who have the discipline to keep going. And if you just keep going, our philosophy is you just keep growing. So yeah, we wrote that piece, hits and misses. We like to look back at how we've done. One of our hallmarks is we're not afraid to be wrong. I don't think lateral thinkers generally are afraid to be wrong because an incorrect prediction is just the basis for the next kernel of learning. And so every 6 months or so, we like to go back and pick a couple of our wins and a couple of our losses. You know, it's easy to cherry pick just the stuff you got right, but that's not what our subscribers pay for. We like to say the only thing worse than being wrong in this business is having no opinion, of course. And to your question, 2026, look, I mean, we've had such a great run. Hard to believe that we're coming up on 5 years. Doomberg, we're ending the year at all-time high in subscribers, paid subscribers, revenue. Everything is just firing on all cylinders for us. We just keep doing this with discipline. Great to see Substack growing. We note with interest that Michael Burry has joined Substack and quickly taken over the finance category. We were joking internally today. You know, we spent 5 years scratching and crawling and climbing the hill and building a Twitter following and leaving Twitter and building our list and going paid and 427 articles and 50 Doom Zoom Pro Tier presentations. Climb the ladder, and then Michael Burry shows up and passes us in 40 days. And we were like, there's a world where you could feel bad about that. That's just not the world that we choose to live in. He's doing great things for Substack. We're investors in Substack. Good for him that he passed us. And on the day that he passed us, we knew exactly how much he was making in that moment because we know how much we were doing on Substack, which is one of the privacy flaws of Substack. But looking forward to another great 2026. You know, we're going to roll up our sleeves, write 6, 7, 8 articles a month. Our goal is kind of 84 a year. We've always beat that. 12 great Doom Zoom presentations. And last thing I'll say is it looks like we're going to have just between me and you, we're going to have a Doomberg book project to work on in 2026, which we're very excited about. Bring the Doomberg message and thinking methodology to a broader audience beyond Substack. We're quite close to a deal. We suspect we'll be beginning to share that journey with our readers at the beginning of 2026 as we set about the task of writing a book, which of course is very different than writing a collection of essays. So lots to look forward to, Ben. And again, it's been a great year and a great 5 years. And when you find what you're meant to be doing in life, you just keep doing it.
Yeah, it's an amazing feeling, I'm sure. And yeah, just between you and me and a few thousand people on the internet, I'm sure everyone will be very pleased and excited to hear that. And I've always admired the discipline framework and the systematic approach you guys have. It's really evident in the way that you start to read through your work, which is why I'm a big fan. And today, a few talking points kind of as food for conversation around some of the things that I've either learned directly from you guys or had learnings consolidated or really rammed home in my own mind. And I've got to say, one of the big ones that really surprises me that it's so underappreciated broadly is that historically, the inflation-adjusted commodity price for almost all commodities, arguably gold is different, tends to decline over time. Maybe we'll pick up our, more macro concerns based on that understanding and why you think so many people seem to get it confused.
Sure. So the long-term real price of all commodities is lower, is a phrase that we have tried to popularize, both in our writing and on podcast appearances to help our subscribers avoid making what we think are foolhardy investments. What do we mean by that? The first thing you have to understand is that we're lateral thinkers and we develop mental models. And one of our mental models is there's an infinite supply of all commodities. Yes, the earth is a finite sphere, but for modeling perspective, you should assume there's an infinite amount of oil, gas, uranium, nickel, copper. Everything else is just price and timing, of course. So that's one axiom. There's just an infinite amount of all commodities. People don't like to think that, but it works. It's a mental model that works. And the second is that mining companies, oil and gas companies, commodity companies in general are technology powerhouses. There's this fallacy on Wall Street that Google and Facebook and NVIDIA are the only technology companies. They are certainly technological powerhouses, but in a whole different domain. But unless you've visited an offshore oil rig, an LNG export terminal, a modern petrochemical facility, you don't realize just how many tens of thousands of engineers and PhDs and technicians do the magic that makes society work every day. And so because there's an infinite supply of all commodities and commodity companies are technological powerhouses, they are deflationary machines. They continuously grind down the cost to produce, even as the resources are harder to get. So historically, you plot a 50-year chart of the price of oil, the price of corn, the price of wheat, the price of natural gas in ounces of gold, and you'll see that the technological capabilities of the commodity players more than offsets geology and debasement. And so why do investors get seduced into buying oil? Because they think oil is going to go up. An analogy for those who trade stocks is that it's like you're buying the VIX. The VIX is just grinding down lower and lower and lower, and then every once in a while you see a spike. And because the demand for oil, for example, is inelastic, every once in a while there's an artificial shortage, crisis of some kind, and the price of oil spikes, and people get seduced by chasing those spikes. Like, wow, like the price of oil went from 65 to 120 when war in Ukraine broke out. And if you had just bought, $80 call options on oil, you'd have made a killing. Our view is it's far better to fade those super spikes than to try to time them. Because as soon as you see an Icarus print like that, stone cold, dead nuts guaranteed, that all shortages are followed by gluts. And within 6 to 9 months, the price of that commodity is going to be down 65, 70, 80, even 90%. And so if you're chasing price spikes in oil, you're bleeding debasement, basically. And look at where stocks are compared to oil. Look at where gold is compared to oil. Look at where silver is today compared to oil. Silver is a unique commodity, sort of a hybrid industrial metal. And it's a slight exception to this rule because most silver is mined as a byproduct, so its supply is not very responsive to price. But for oil, for gas, for corn, for wheat, all these things that are super responsive to price, anytime you see a shortage, industry overreacts. They generally don't have good discipline, and a shortage quickly follows. And so this feeds into our sort of suggested investment philosophy. We don't give investment advice, but we certainly are happy to provide a strategic viewpoint for people to shape their own investment decision making. Don't buy the commodities and don't buy the commodity producers. Buy entities, companies that are leveraged to volume. Energy demand is always growing. And so if you're a service provider, you help with the produced water situation in the Permian, or you've got an advanced proppant that you're selling, or those are interesting companies to us. But if you're just a run-of-the-mill, price-taking deflationary machine, if you're a deflationary machine and you have to take prices that the market gives you, where's the upside in owning that? So that's a broad philosophy that we have. There's a bunch of others, but that's a pretty important one.
It certainly is an important one. And whilst, as you mentioned, those particular producers might do a great service to society, they don't necessarily do a great service to shareholders over the long term. And as you mentioned, being not so sensitive to price, but having at least an ability to clip the ticket on volume in some of the leaner years is why I personally have, over the last few years, really based my philosophy around, or my investment focus around, royalty and streaming companies, or the midstream toll booth types of business models, where there's really a very short distance between the top line and the bottom line. They're far less capital intensive and they can survive some of these lean years. And as you mentioned, when the VIX or the commodities have their occasional spike, that's all a free embedded call option. And you guys, I think, have really put that together in this notion of, it's like trying to time the VIX versus just fading a spike when the inevitable volatility event occurs.
Yeah, I think a rule of thumb, look, it's hard to call a top, of course, but as our friend Tony Greer over at TG Macro likes to say, if you're not going to sell into strength, when will you sell? The rule of thumb that we find in a super spike in the commodity space is whenever you see what you know is an aqueous print, any retracement of, say, 20% is a safe bet. At 6 months out, you're going to see a much lower number than you're currently looking at on your screen. Look, directionally, it's a good edge. Physics as an edge in investing and trading is a pretty powerful tool. It's not going to be 100% right. There's no sure things. But broadly speaking, the advantage of physics is you know what the thermodynamics should be, where it ought to be. And the farther away you get from that, the more confidence you can have in betting that the mean will be regressed to. And so that's sort of a sort of overarching guide. At least you can avoid swimming upstream, if you know what I mean.
Yeah, absolutely. And you mentioned a lot of commodities that I certainly am interested in, which I overlay with a capital light business model. Gold, land, and particularly water. How do you see those in comparison to, say, energy commodities? Because gold can be considered a commodity, but it doesn't suffer the same fate of, on an inflation adjusted basis, decaying in terms of its prices over time. Gold is just gold, right?
Right. So gold's not a commodity. Gold is, in our view, the center of the financial universe. It is the ultimate store of value. There is no money today. So there is no vehicle, the US dollar, Bitcoin, gold, the euro, the yen. There is no vehicle that satisfies all three of the criteria to be money, medium of exchange, store of value, unit of account. The US dollar fails on storage of value, and gold and Bitcoin fail on unit of exchange. You can't go buy your groceries with gold coins or Bitcoin. Maybe at the margin. So anybody who's like pro Bitcoin, don't blow me up on it. But broadly speaking, I can't fill my car up with Bitcoin. And land is in that category of store of value / savings vehicle, not quite gold because it's not nearly as liquid. And then water is a whole different ball of wax. And I would put water in the same category as oil because the demand for it is so inelastic. And we know how to purify water because we're quite literally drowning in water on the planet. But we did a whole Doom Zoom presentation on water, the difference between potable water, fresh water, salt water, industrial water, drinking water that you might find in a municipality. And so water is many, many, many products. And chemists know how to convert between them. And any shortages of a particular supply of water will be met with an overwhelming supply response eventually. So I would view water in a very similar bucket to oil, gas. Now, look, if you live near the Great Lakes, water's free, right?
Right.
And if you live in California, water's expensive. It's very similar to natural gas in that way. Once you build out the infrastructure, California could solve its water issue just by building out, a bunch of nuclear power plants with desalination facilities next to them. It would be very cheap to do that. And so to the extent that you think about whoever the midstreamers are or the royalty players are, people who have intellectual property on reverse osmosis membranes, and every membrane that gets used, they get a buck or whatever. Like those types of companies are interesting, very similar to us in that way to like the people who move hydrocarbons around, purify hydrocarbons, and send them through a refinery. You can think of a desalination plant as a refinery for water. Salt water comes in, fresh water comes out. You have to deal with the byproducts, yada, yada. So very similar in that regard. Like oil and gas, there's an infinite supply of water on the planet. I mean, we're drowning in this stuff. 70% of the surface of the earth is covered by water.
Yep, indeed. And when it comes to water as a waste product, one thing that has caught my eye has been this problem of produced water in particularly the Permian Basin.
Mm-hmm.
And reading through, if we take the view that any potential spike in either oil or gas, which we can touch on in a moment, will lead to an increase in production in those areas, the type of production will inevitably lead to an increase in terms of the produced water coming to the surface along with the hydrocarbons, right? How do you guys view that current issue? Is it simply a case of eventually the price to handle and process this particular water will just be such that it will encourage more players into the space and the tech wizards and engineers will figure out a way to handle the problem? Or is it something that you haven't taken such an interest in?
Well, we've taken an interest in it, haven't yet written about it. Yeah, produced water is just another of the barriers that permabulls like to point to that will somehow magically constrain supply, and finally their favorite commodity will go up in price. We have, of course, a wholly different view, which is anything that is on the critical path of more energy production will get destroyed. And so that problem is eminently solvable. It's a matter of expense and investment. It's another opportunity for midstreamers. We see enormous developments in the private markets in and around the Permian of players that are mastering taking produced water from the well and re-injecting it across the state in various domes and all this other stuff, as you know. And so that is hardly a crippling challenge to increase production of oil and gas in the Permian. And, we've had some fun over the past couple of years needling what we sort of call internally these peak cheap oil truthers. Everywhere they look, they see the end of oil. And boy, one of these days they're going to be right.
Sure. I'm not so much thinking along the lines of peak cheap oil, but just simply there's plenty of oil in the Permian Basin, for example. It's a question of economics in terms of as let's say your water cut is 4. So for every barrel of oil that comes to the top, 4 barrels of produced water comes along with it, and it's toxic stuff. You've got to process it in a certain way. Is it likely to be a case that the marginal barrel then costs more to have it removed, given that there's a certain way that it has to be processed and injected?
So you can't look at the marginal barrel in the Permian, which is the other big change in the markets that the shale revolution has brought that few analysts have fully internalized, but we've tried hard to incorporate into our writing. The break-even cost to produce a barrel of oil in the Permian depends on the price of natural gas because they're co-produced. And so in a world where AI demand pops natural gas to $5 or $6 or $7 per million BTU in the Permian, where its spot prices today are trading negative. I checked just before we came on at the Waha Hub, minus $1 per million BTU and change. The price of oil is irrelevant to those producers because you're getting so much money from the natural gas. And so back to your question about produced water, that's a classic example of what we were talking about earlier. If you have an axiom that oil and gas demand is infinite and all that matters is supply, then that's the type of problem that we would be interested in investing in companies that have a solution. They're the enablers of volume. You want to be long enablers of volume because the safest bet on earth is that the statistical review of world energy's global energy consumption chart is a line that goes up and to the right. COVID, wars, famines, bumper harvests, it doesn't matter. The demand for energy goes up and to the right and will continue to do so. And therefore, any technologies that either debottleneck production or unlock more of it are disproportionately valuable. That's how we would view produced water. Not as a constraint or a reason to get long oil.
Right.
As a bottleneck that will get broken and there will be a price for the innovators who do it.
Yeah, I agree. That's exactly how I see it. I think enabler of volume or bringing on new supply is a good way to look at it. And that's, again, why I like royalty companies that own land with royalty rights for not just the underlying minerals, but also easements and water processing, of which there are quite a few. You're touching on another key point that I learned directly from you guys. I must admit, I didn't think about this in the right way going back a couple of years. A lot of fairly high profile hedge fund managers and research firms that use oil inventories as their North Star. But what I've really come to appreciate having read your work is that there are a lot more factors involved than that. And of course, I'm referring to the co-production dynamics of oil and natural gas. You don't just produce one in isolation. How do you see the current dynamics in terms of the market? And what do you think is missing in terms of investors like the old me, let's say, when they were trying to put together a framework for supply and demand?
I didn't set you up to this, but it's the subject of a piece that I'm currently writing.
Oh, there you go.
That will be probably be our last piece of the year, be out next week. Everything you think you know about oil is now no longer operative. And I'm shocked to see people on Twitter who claim to be oil experts. I'll list you through some of them that we're going to cover. So you alluded to one, which is inventories, like Cushing, right? Why does Cushing matter far less? One of the reasons why Cushing matters far less is because spud to sale has been radically short. It used to take a long time to bring a new well online. And now you can think of drilled but uncompleted wells as basically inventory. It takes weeks for a refinery to tell the driller they want some crude or they want some light crude or they want some NGLs. And boom, they get it. Cushing doesn't matter like it used to because crude oil is not oil. Crude oil is a part of a broader definition of oil. In our view, oil is any hydrocarbon that finds its way to a refinery. And that includes condensates, NGLs, and yes, increasingly natural gas. And the opening story for this piece is not yet written, but I like to sort of write them in my head before we pen to paper, is we're going to talk about Mont Belvieu, which is probably the most important energy complex that almost nobody's ever heard of, outside of the industry, of course. I mean, people who work in the industry would find what I just said to be silly, but Mont Belvieu is the NGL capital of the world, natural gas liquids. What are NGLs? The NGLs are in the definition of oil as presented by the Statistical Review of World Energy. The U.S. does not produce 13 million barrels a day of oil. It produces 13 million barrels a day of crude oil and another 7 and 7.5 of natural gas liquids, which is also oil. And so it produces 20.5 million barrels per day of oil, not 13.5. And if you just ignore that whole side of the market and its dynamics, then you're looking through, looking at the world with one eye. There's a whole other universe out there. So Mont Belvieu, just to give you a sense of scale, processes 4.5 million barrels of natural gas liquids a day. It would be a huge member of OPEC if that entity were to stand alone. Now, of course, it's an industrial complex with many companies, but it's like way more important in many ways than Cushing today. And NGLs are ethane and propane and the butanes and so on, all the way up to C5 and C6s, a little bit of C6s. And these things are displacing what oil used to do because we're just swamped with them. Engines are being switched. Petrochemical plants are being switched to run on ethane only instead of cracking naphtha. All of this sort of pushes heavies back into circulation and dampens the price of crude. And so Mont Belvieu can store 250 million barrels of NGLs. Okay, so you're talking like roughly half the size of the Strategic Petroleum Reserve. How much is in the Strategic Petroleum Reserve today is sitting in Mont Belvieu, and nobody talks about it outside of the industry. And this has all come up like overnight, 15 years, right? And so you've had this massive sea change in the molecular definition of oil. We like to say that oil has undergone a molecular semantic shift. And so you can't just look at crude anymore. So I'll give you a few more examples of variables that just don't matter. Cushing inventories, we just talked about one. Rig counts. What do backwards-looking rig counts mean? Nothing, because rigs are becoming ever more productive. You name it. Like the old indicators that you might have as a pilot analyzing the crude oil markets when crude oil was a standalone, isolated market no longer work, and people still use them. I was having a text exchange with a very popular analyst who I love and who I read thoroughly and just gets energy wrong repeatedly. And I try to text this person like, come on, and he made a point that the reason why the U.S. is invading Venezuela is because it needs its oil. And I was like, what are you talking about? And he goes, and he sends me a picture of crude oil production. And it's like, it's basically flat the last 8 months. And he says, NGLs don't count. I was like, and so I don't know if you know that meme, where the guy's pointing at the mirror, it's not you.
Right, yeah. It's the bull market.
Right. I sent him that meme. I said, it's not that you don't understand energy. It's that NGLs don't count. Right. And I couldn't help myself. And we're just good enough friends that we could give each other crap like that. But it's amazing to me how many people, in fact, that text exchange inspired this piece that we're going to write. Here's all the things that are different about the crude oil markets that you just haven't internalized yet.
Yeah, and I can empathize with how someone might arrive at that conclusion if you kind of accept the traditional wisdom. And that's what I did, traditional notions of things, that there's something particularly special about liquid crude oil that can't be made up by NGLs or even other forms of hydrocarbons to satisfy an end use case. And if I'm not mistaken, I believe it's you guys that have also spoken about molecules of hydrocarbons eventually just being interchangeable. Am I correct in saying that?
Yeah. So again, you just said something very important, like crude oil, right? So what do we do with crude oil? We refine it and we make basically jet fuel, diesel, and gasoline. Okay. So if you look at the engines in society, they're roughly proportionate to how much gasoline, jet fuel, and diesel that you get from a barrel of crude. Well, that's because that was what was in crude when we made all those engines. Okay. So now that we have this tsunami of other hydrocarbons, there are two ways to take advantage of that energy arbitrage. One, we switch the engines. We don't have to run our planes on jet fuel. We tuned our jet engines to run on jet fuel because that's the incremental part of the barrel that was left over after gasoline and diesel were taken out. We don't have to run our long haul trucks on diesel. We can run them on LNG. So we could switch the engines and engines will get switched. Heat is heat. You give me a source of heat that is a fraction of the cost of something that comes from crude oil, you're going to switch eventually. Enough will to equalize those prices. But beyond that, chemists know how to scramble these molecules. So you could take natural gas and make diesel. Shell does it at its Pearl plant in Qatar. China takes coal and makes diesel and jet fuel and so on using the syngas chemistry that was perfected by the Germans and is used by the South Africans, out of necessity because of sanctions and war.
I find fascinating the ability
so
to make.
You give me natural gas liquids and I could make gasoline, I can make diesel, I can make jet fuel. So both of those things are happening concurrently. Chemists are scrambling them. Refineries are investing to adapt. And we like to say, by the way, that the magic of chemistry puts a ceiling price on the equilibrium price of oil. It puts a ceiling on the equilibrium price of oil because if oil got to $300, we'd just start making syngas plants and we'd make it from natural gas and coal and NGLs and whatever else you can make syngas from. And once you get the syngas, you can make anything. The Fischer-Tropsch chemistry is well understood. It's a bit expensive, but if the sort of break-even price for gas to refine products in Qatar, and let's say it's $60, $70 a barrel oil. Well, if oil's $300 a barrel, it makes a hell of a lot more sense to take free natural gas in Qatar and make diesel and jet fuel and gasoline out of it while you're busy switching the engines too. And because demand is so inelastic, it doesn't take much in the way of switching for prices to equilibrate. So when you take that through to its sort of deductive reasoning, logical conclusion, in the long run, all hydrocarbons will sell for the same price, corrected for energy content and logistics. And we see that.
Is this the case where you would use, let's say, as a barometer, you might take JKM, for instance, so you're taking gas and liquefied it, and then times it by 5.88 to adjust for the amount of BTUs?
Depends on the grade you're comparing it to.
Right, okay.
We say 5.8 for Brent.
I see.
So if you plot Dutch TTF, which is the European version of the Asian contract that you just quoted, JKM, you take 5.8 times landed LNG at the Dutch TTF terminal and you plot it against Brent. During normal times, they trade in lockstep with each other. Why? Well, another surprising fact is that there's 4 million barrels per day of oil that is used to make electricity. It's burned to make electricity, predominantly in the Middle East. About half of that is in the Middle East. And so, of course, natural gas is a superior fuel to burn to make electricity. It's cleaner. And so that switching means that as long as oil is burned to make electricity at some reasonable scale, then in times of relative tranquility, i.e. not a crisis, Brent crude and landed LNG should trade for the same price, and they do. And in fact, that pair trade, for now, is an indicator of crisis for us. It's an early warning indicator of crisis. There's a crisis in the world somewhere if those things get out of whack. Once we stop burning oil to produce electricity, those things need not trade in tandem anymore. And so the first time that it doesn't trigger a crisis or it doesn't reflect a crisis, it tells us that there's structural change in the market where we're no longer burning that much oil to the point where switching is relevant. That's one thing about energy markets that people also fail to internalize is that they're very fungible today, and they're only getting more fungible over time. So we wrote a piece, what does the rain levels in Sichuan province in China have to do with the price of coal in Appalachia? Everything, because China switches between hydroelectricity and coal depending on rain levels. And so these are the types of interdependencies that you have to understand if you're going to analyze markets at a high level.
Indeed, they are. And I think it's a big misconception. I certainly didn't appreciate the ability for engine switching to occur. And I think a lot of people are just ignorant of that fact. A question around the economics that might be necessary for such switching to occur. You mentioned it's a bit expensive. How much are we really talking in terms of if there was a huge change in one byproduct versus the other? What do you think, generally speaking, would need to occur for a change to be seen in markets?
It's like any NPV calculation. What's your upfront expense and what is the savings, which is your payback over time, and what's your break even, what's your cost of capital? It's not only just financial though. So a great example of engine switching that has materially impacted the market is China's move towards LNG powered trucks in the cities, which is driven at least as much by PM 2.5 measurements in Beijing and Shanghai, which the CCP is very much worried about. So what do I mean by that? PM 2.5 is particulate matter, 2.5, a certain size that floats up in the atmosphere. And for a long time, when I used to go visit Shanghai, um, you'd barely go outside. You get back to your hotel at night and you wash your face with the cloth and it's black because there's so much particulate matter in the sky and the pollution. And this was a big deal, very big deal. And in fact, US Embassy used to publish its readings of the PM 2.5 measurement, which the CCP couldn't control, and netizens would be able to get access to via VPN. And so the CCP was highly sensitive to pollution, which was driven in large part by coal burning, which has since been moved out into more rural areas, but also by diesel trucks that were emitting, unfiltered solid pollution into the cities as they were delivering their various goods and wares. And so the switch to LNG powered trucks in China has dampened the demand for diesel significantly. So has the switch to electric vehicles in the cities in China for passenger cars, which has dampened the demand for gasoline. You could see how they're trying to sort of get the whole barrel under control. But it came with added benefits, both automotive but especially long-haul heavy truck pollution in the cities has all but dissipated as they switch away from diesel towards a combination of LNG and electric. That's just one example of engine switching that you have to internalize if you can understand how the markets work. But broadly speaking, to your question, if I'm a long-haul trucker going in and around the Permian and natural gas is free and diesel is, $70 a barrel or $4 a gallon, why wouldn't you make that switch? There's a finite cost to the engine, and then the fuel pays for itself.
Yeah. And last question on gas, because we can start to move into the geopolitics. I've got a nice segue. It's something I think about a lot in this case of, you mentioned Waha is currently negative. There's a lot of noise being made around in markets with the arrival of data centers and their rollout, in addition to more investments being made into liquefying natural gas in the US and taking advantage of the arbitrage, which we've touched on, be it in Europe or in Asia. If this starts to actually bid up the price of natural gas, at least in the short to intermediate term, the idea that that might actually almost accidentally, as a byproduct, bring more oil onto the market and further dampen the oil price. I'm interested in how you see things currently through that particular lens.
Yeah, one of the challenges right now that I think is facing the energy complex is there's a glut of liquefied natural gas coming. And today, landed LNG is below our equilibrium price. So take a step back. 2 years ago, we debated a pretty famous peak oil person on a high profile podcast. And we said that our equilibrium price for oil is $55 a barrel. And we arrive at that price by landing at $10 per million BTU. Because at $10 per million BTU, everyone in the chain can earn their cost of capital. The drillers in Appalachia, the midstreamers that bring it to the Gulf Coast, the people who liquefy it, the cargo ship owners who bring it across the ocean, and the LNG receiving terminals that regasify it. $10 per million BTU is roughly our equilibrium price. And right now it's at $9.50, below our equilibrium price. That's front month. 12-month strip is a different story. But broadly speaking, front month contract's a good indicator of where the market is. And there's so many terminals being built to the point where we worry about the glut and a lot of money being lost on building these terminals. And that will keep more gas in the US than others otherwise would be. But on the other end, on the sort of the tailwind is this boom in AI data centers. We're starting to see the market wonder whether this will be true. We think it will be true. Maybe not at the scale that everyone is announcing, but there will be a meaningful increase in demand for natural gas for AI data centers going forward. And again, you can't have natural gas be free and oil be at 56 indefinitely. Even Henry Hub today, is down under $4 again. Weather must be getting warm. The oil to gas ratio is back up above 14, well within its historical range, but energetics would say it should be 5.6, like we talked about earlier. And so the market is beginning to be very, very well supplied. And if the market is very well supplied of natural gas, it's generally speaking going to be very well supplied of oil as well. Because again, at $9.50 LNG, you're agnostic to the price of Brent. That means the entirety of LNG is another option for you. markets are very, very well supplied. I'm amazed to see people write and people go on podcasts talking about a super cycle in oil coming. In what universe are these people living in? We talk to people in the industry and we're just drowning in this stuff. So anyway, it is what it is. But yeah, like when I look at LNG today at 950, scratch my head when I look at all these big projects that are already FID'd and ready to go and concrete's being poured and pipes are being laid. There's going to be a high pucker factor moment here for LNG exporters in the next 18 months, in our view.
Speaking of new and impressive sources of supply coming online that have kind of been
Yeah.
I would say gridlocked for a while. I'm down here right at the bottom of the Vaca Muerta region in Argentina, and the place is absolutely booming with all kinds of new infrastructure projects going on down here. How do you see Argentina in terms of the next 5 to 10 years? Milei has had a successful midterms. Obviously, he has another term if he's successful coming up in about 2 years. Is Argentina on the Doomberg radar? And which commodities, I suppose, does it promise to provide the world should this Argentine miracle continue?
Look, geologically, Vaca Muerta, which we've written about several times, I'm glad that you're able to provide anecdotal evidence for what we know must be true. That resource is every bit as good as the Permian Basin. What has constrained its production is politics, predominantly, and lack of a critical mass, right? Broadly speaking, when a critical mass of super majors and large oil companies assemble in an area, we wrote a piece called Blooming Flower. The same thing is going on in Guyana right now. You've got all these super majors down there. The cost to get them there has been paid. Let's look around in the immediate neighborhood for more that we can do, which is why you'll see Trinidad and Tobago and why we have all this action in Venezuela and why I think Cuba might even be the real target of this whole Venezuela thing because of the oil and the offshore in northern Cuba. But the Vaca Muerta, that is an incredible resource. There's no reason why 5, 6 million barrels a day couldn't happen down there. And the full suite of natural gas and NGLs that we just talked about. Like there's a tsunami of hydrocarbons waiting to be developed. Chevron is knee deep down there, I'm sure you've seen. So, in fact, that the bailout of Malay, we predicted in a piece called Mosaic Theory a few weeks before it happened, because look, the US is very interested in developing that resource. And by the way, Argentina, this is a lifeline of hard dollars for the country. If Vaca Muerta blooms to what its potential indicates that it could, Argentina's going to be back on its feet, potentially permanently. That's a huge source of much needed hard currency to deal with, decades of disastrous policy. And so it's one we watch every day. We have certain Google alerts, Guyana and Vaca Muerta and a few others on our list to keep very close track of it. It's one of the most exciting plays in the world. When the Malays Party did surprisingly well in the midterms, we posted on Notes, which is Substack's version of Twitter. It's our preferred social media outlet. That it looks like Vaca Muerta won the midterms. It was a surprise. We were kind of surprised and smirked a little bit at that vote tally, because it seems like perhaps the Argentinians have learned how to count votes the American way.
Impressive is what's really impressive. Perhaps this anecdote might serve people that haven't been here on the ground. Is that the majority of the support, the electoral support for La Libertad Avanza, is the Malays party, are all young people. So there's a case into the future that the right thing will be done at the polls. Let's say in terms of encouraging the country to not just return to prosperity, but to break this cycle of volatility that it's seen in the past. I believe the bailout was sort of structured down here. It was framed as a strategic investment from the United States. And I think the guys north of the border did reasonably well on the peso trade as well. Uncle Scott Bessent knows a thing or two about foreign currency trading.
Well, they better hope the Republicans win in 28, because there's going to be a lot of people going to jail if they don't.
Well, that's a problem for, what does Homer Simpson say? That's a problem for future Homer or something like that.
Yeah, exactly.
Yeah. You mentioned Venezuela, and there was all sorts of noise made on X over the last week, I believe it was, that there was going to be an announcement that the US was going to put boots on the ground. I would be very interested in your take in terms of what you see happening in Venezuela, how you think all of this may unfold and be resolved.
Yeah. So luckily for you, we're publishing a piece on this tomorrow, actually.
Great.
We're recording this, I guess, on Monday. Yeah, we don't know what's going on in Venezuela. And so when we don't know what's going on in Venezuela, we do sort of a lateral brainstorming exercise, and we decided to share with our subscribers the result of that brainstorming exercise tomorrow in a piece called Silent Allies. And the thread that we pull on that piece is the surprisingly muted response of Russia and China to this whole affair and what that might actually mean. So, as you know, we like to think about problems in a sort of non-traditional way. The opening story for that piece, of course, is Sherlock Holmes is the dog that didn't bark. And we find that Russia and China are not barking at all compared to what the strategic significance of Venezuela to the both of them would indicate they might do.
That's highly
And
curious.
and we walk through 4 or 5 potential explanations for that, ranging from conventional to highly speculative. Now, we don't want to give the full piece away, but there's a few possible interpretations of what's going on, up to and including that Venezuela isn't even the primary target. There's a school of thought that the drug trade is actually very meaningful to much of Trump's enemies, and if you view the Trump administration as being engulfed in a civil war with a combination of Western deep state, European and British banking interests that are spread across the Caribbean, for example. You can imagine where disrupting the hundreds of billions of dollars of the drug trade and the associated money laundering and beak wetting, as we like to call it, that goes on as people catch a vig at each step of the way as this money is laundered into the proper financial system. There's an entirely different way to look at this set of affairs than, as we say in the piece, "Orange man bad want oil." So we'll see how it goes. It's a bit of a different piece for us. A little bit more speculative. The speculative stuff comes after cut to paid, so at least if you want to troll us for a bad analysis, you have to pay to do it.
Yeah, it's a nice structure. Rest assured, all your details will be left in the description of the piece. As we look forward to the end of 2025, what's the one thing that surprised you? Maybe we can wrap it up here in terms of, as you look back, is there anything that really stands out in a year that's been quite volatile, both in markets and geopolitics? What's the one thing that's really caught your attention about 2025?
This is, again, it's not meant to be political, but you have to understand politics to understand geopolitics. We're surprised at Trump's undying desire to please people who clearly hate him, be it the neocon wing, the Forever War Party in Washington, or the European elite who have little to no time for Trump at all and actively campaigned against him. Why Trump cares what Lindsey Graham thinks or what Keir Starmer thinks or what Emmanuel Macron thinks is a real mystery to us. Like, he had a plan. Half of his administration still wants to do that plan. He campaigned on that plan, and yet can't bring himself to stare down his real enemies and get about the task of executing his campaign promises with a little more rigor and vigor. So it's a real mystery to us. It's something we've puzzled with a lot. There are lots of sinister interpretations of that, or the most obvious one is he's a people pleaser, and he doesn't like to, he actually is confrontation averse. But there is a whole bunch of people even surrounding the president today that do not want him to succeed. He has to know that. He lived through it for 4 years. He got off to an amazing start. Again, just agnostically, he moved with such speed the first 100 days. But since, late spring, he's just stalled on a lot of things. The war is not over in Ukraine. He comes to an agreement in Anchorage with Russia, and then immediately the Europeans and the Ukrainians step in and water it down to the point where he might as well have not met with Putin in Anchorage. So it's a mystery to us. Look, they tried to kill him twice. What does he care what they think? So it's a pretty amazing thing for us to watch. And if we understood that, the reason I bring it up, again, it's not to be political, is because if we understood that, we'd be far better at our jobs because we'd be able to skate where the puck is going. So anyway, that's the most surprising thing to us in 2025 is Trump has still not figured out who his real enemies are and continues to play the game with them, which is really shocking.
Yeah, is it a case that he doesn't know who they are, or it's more a case that he needs to play the political game and have the power to enact what it is that he really wants for his game?
Great question. And that's a line of thinking we've pulled on that thread. And that has led us to test a mental model that we published as a note, not yet worked its way into a piece. One of the mental models that we're testing for how operative it is, and our test of a mental model is whether it predicts things, is that if you had I guess we did actually write this in a piece. If you had a secret ballot in the House and the Senate, 80% of the sitting members would vote to impeach and remove him. There is no Republican Party in DC. I see right-wing Twitter lamenting the fact that the Republicans won't destroy the filibuster. There is no Republican Party in DC. A uniparty. Mitch McConnell and Chuck Schumer are on the same team. I hate to break it to you. And they both hate Trump. Trump is disrupting, in their mind, the flow of money to the military-industrial complex. War is a racket. When you're in the bomb-making business, peace is a working capital problem. And so, yeah, he does not have the political support. They pretend. They have to pretend because they'd get primaried and nobody wants that headache. And they're all just running out the clock until like 2028. But I would guess 35 Republican senators would prefer Gavin Newsom to Donald Trump.
Wow, that's a bombshell, and we might leave it on that bombshell. Doomberg, thank you so much. It's been a fascinating conversation as always. Once again, congratulations on all the success and wishing you a very Merry Christmas and Happy New Year. If people want to learn more about your amazing insights, where can they find it?
Yeah, we actually have two projects, if you don't mind. We have Doomberg, of course. You can find everything at Doomberg.com. And on Doomberg.com, you can find our new sister publication we launched in September called Classics Read Aloud, which has really been fun, and it's been amazingly successful. Classics Read Aloud, as the name implies. It's all about curating and bringing back to life really great literature before it's lost to history. Classicsreadaloud.substack.com is our sister publication. And there's a lot of interweaving between the two. It might not seem obvious, but there is. And it's produced in the same Doomberg brand. So Doomberg.com for all of our energy, finance, and geopolitics. And then if you want, you've got 2 hours to kill on the highway and you want to hear a great piece of literature read to perfection and produced in high quality, head over to Classics Read Aloud as well. And look, Ben, congrats again on 100 shows. Be sure to have me back on for the 200th, if not a few more times in between.
Oh, absolutely. We'll always make time for you, no matter where I am in the world. Once again, guys, Merry Christmas, Happy Holidays, however you celebrate, Happy New Year, and muchos éxitos en 2026.